Hello, my name is Ron Copley. I have a PhD in the area of finance and I'm a chartered financial analyst. I am the principal at Copley Investment Management. We manage about a little less than $100 million for about 100 different families, and I'm very pleased to introduce myself to you and talk about exchange-traded funds as a very important topic in the market today. So I'd like to take this opportunity and tell you a little bit about what an exchange-traded fund, ETF, is and some of the advantages. Why are we using them here as opposed to open-ended mutual funds? Let me give you the short answer. The short answer of an exchange-traded fund is that it is a mutual fund index that trades like a stock. It trades throughout the day. Now, what happens with a mutual fund is that you don't know if you put in $100,000 or $100 for that matter into a mutual fund at 10 o'clock in the morning, you don't know what you bought or how much of the fund you bought until 4 o'clock in the afternoon when the market closes. So with an exchange-traded fund that trades throughout the day, just like any other stock, you put in $100,000 or $100, whatever it may be, into the ETF at 10 o'clock in the morning. You know how many shares you have at that very moment. Now this really opens up some possibilities for an exchange-traded fund that a mutual fund does not have. An ETF, because it trades like a stock, you can short sell it, which means that you simply can borrow it from your broker, sell it, and then hope that it goes down in value. I'm not suggesting that. I'm just saying these are some possibilities that an ETF has that a mutual fund does not have. An ETF is also very significantly more transparent. A mutual fund may at the end of each quarter disclose its holdings, whereas an ETF under regulation must disclose its holdings at the end of each day. And their technology has really come a long way for an ETF. An ETF is cost efficient, and because of that, of course, it's putting more money in your pocket when you use them. And finally, an exchange-traded fund is very tax efficient. Without going into great detail, what happens with an exchange-traded fund, it's actually an exchange, and it's a swap. And because of that, there can be tremendous tax advantages associated with the ETF. How are ETFs created? It takes a sponsor, and it takes what is called an authorized participant. Now, these terms, don't get hung up with them because it's just terms. But a sponsor, if you take, for example, a sponsor like iShares. iShares is owned by BlackRock. iShares is the sponsor of a host of exchange-traded funds. One in particular would be the S&P 500, IVV. If the sponsor, who is iShares, wishes to create an exchange-traded fund that tracks the performance of the S&P 500, iShares would issue 50,000 shares of the ETF and swap that ETF with a basket of 500 shares of the S&P with an authorized participant. Who is the authorized participant? Well, the authorized participant could be a big bank, could be a specialist on the New York Stock Exchange, could be a large investor, a hedge fund. So there is an exchange going on. That's the key point. The exchange of the creation unit that has been created by iShares in this example with an authorized participant, who then, what happens is that the authorized participant now is in possession of 50,000 shares of an exchange-traded fund. So the question is, what does the authorized participant do with these exchange-traded fund shares? Well, they can do two things with them. Number one, they can hold them for investment. That's altogether possible. Now, the exchange that I just explained to you is a primary market exchange. It's not secondary market yet. It's in the primary market. Now, once the authorized participant has possession of the exchange-traded fund shares, If the authorized participant sells them to investors like you and me, then that is a secondary market transaction, in which case there is a fee involved for the authorized participant. That's the way they make their money. It's a small fee, but it's a large volume, and hopefully the large volume will make up for the small fee. So that's the way the creation of an exchange-traded fund occurs. So how closely, once the exchange has occurred, how closely does the market price of the exchange-traded fund reflect the net asset value? And as it works out, it's very close. The two rarely get very far away from each other. And the reason that they are so closely aligned is because of arbitrage. Arbitrage is simply a fancy word that means that if the same asset is trading in two different markets and they are trading at different prices in the two different markets, then you would buy the commodity or the security that is undervalued in the one market and sell it in the overvalued market, the other market. So this arbitrage pressure will keep the net asset value very closely aligned to the market price of the ETF. Now, how do ETFs achieve greater tax advantages? Well, bear in mind that a mutual fund, whenever a mutual fund manager makes a transaction, you are the beneficiary of that transaction. So throughout the year, the mutual fund manager may be buying and selling. You may not be into the mutual fund until maybe later on in the year. So all of the transactions that have occurred that the fund manager has made up until the time you buy the fund, these are taxable events that are affecting you as a mutual fund investor. The ETF is not done that way. The ETF, the only time that a taxable event occurs with an ETF is when you sell it. Not the fund manager, because that's not the way an ETF works. It's only when you sell it. So you control the tax implications of the ETF, whereas with a mutual fund, the fund manager controls those taxable events. What do you look for when you're looking to buy an ETF? This is certainly something that I do almost every day. But when you're looking for an ETF, I'm going to point out three things that you need to be looking for. Number one, you have to be comfortable with a passive strategy. An ETF is an index fund. It represents a broad base, a basket of goods, as indicated with the S&P 500. You have to be comfortable with a passive strategy. Secondly, all ETFs are not created equal. You want to find an ETF that has a management fee as low as possible. And certainly they are significantly lower because of the efficiency of the way the exchange takes place between the authorized participant and the sponsor. These management fees are quite low. Generally speaking, about half, maybe even lower, maybe even less than the management fees of an open-ended mutual fund. Finally, when you're looking at an exchange-traded fund, you want to take a look at the bid-ask spread. And the bid-ask spread is going to reflect the volume of the ETF. A very large volume of ETF, of trading activity in an ETF, would suggest that the spread is probably pretty small. It's just kind of like a used car salesman. If a used car salesman has got a Ferrari coming onto his or her lot, chances of that Ferrari trading very rapidly is very low. So it might sit there for a while. As a consequence, the markup, which is what the bid-ask spread is, the markup on a Ferrari is going to be quite high. Whereas if the car were a Honda and the car lot had a lot of turnover with Hondas, the spread or the markup on a Honda is probably pretty small. The same thing happens in an exchange-traded fund, or to tell you the truth, any stock that trades on a listed exchange wherever across the global markets. So the three things to look for. Be comfortable with a passive strategy, look for low management fees, and also try to find the spreads that are as narrow as possible. That's it. I hope I didn't go too much in detail. I didn't intend to make anybody an expert on ETFs, but this is an important topic because exchange-traded funds are certainly becoming very popular, the investment vehicle of choice for many investors, both on the retail side and on the institutional, both for amateurs and professionals such as myself. I hope this is of some help to you. Thank you very much for your time. Have a good day.